For most of the last 3 decades, China's economic expansion was treated as a structural constant. Growth above global averages was not a surprise. It was expected. From the early 2000s through the post-2008 stimulus era, China's model relied heavily on a powerful combination: high savings, state-directed credit, infrastructure expansion, and property development. When the global financial crisis hit in 2008, China responded with an enormous stimulus package focused largely on construction and infrastructure. Credit surged. Local governments accelerated projects. Real estate development intensified. Steel production expanded. Cement output soared. That response prevented a hard landing at the time, but it also deepened a structural dependency. From that point forward, property and construction were not just sectors of the economy. They became core stabilizers. Residential property in China did not function merely as shelter. It functioned as savings, collateral, and wealth storage. For many households, owning multiple apartments was less about consumption and more about preserving purchasing power in a system with limited investment alternatives. When prices were rising, the system reinforced itself. Developers borrowed to build. Banks lent against appreciating collateral. Local governments financed infrastructure through land sales. Households purchased pre-sale units years before completion. It worked as long as 2 conditions held. Prices kept rising. Confidence remained intact. But growth models built on perpetual appreciation face a structural ceiling. By the late 2010s, leverage across developers had increased significantly. Many firms expanded aggressively, using short-term funding structures to finance long-term projects. Land acquisition costs escalated. Competition intensified. Pre-sale models became more dependent on continued price optimism. When regulators introduced tighter borrowing constraints under the 3 red lines policy framework, liquidity conditions changed abruptly for developers that were already heavily leveraged. This is where the narrative often simplifies the story to developer defaults. But that framing misses the deeper mechanism. The issue was not just corporate failure, it was balance sheet saturation. Developers could no longer roll debt forward at the same pace. Pre-sales slowed, construction timelines extended, confidence began to erode, and in property-driven systems, confidence is everything. As projects stalled in various regions, households began to question whether future price appreciation was guaranteed. Mortgage boycotts emerged in isolated cases. Sales volumes declined. Inventory increased in certain provinces. None of this resembled a sudden crash. It resembled slow deflation. And slow deflation is more complex than crisis. In a crisis, policy reaction is clear and aggressive. In deflationary adjustment, policy becomes cautious. At the same time, local governments faced increasing fiscal strain. For years, land sales generated substantial revenue streams. As developer appetite for new land cooled, revenue pipelines weakened. Local government financing vehicles, often used to support infrastructure projects, became more sensitive to refinancing conditions. This created a secondary layer of pressure. Property slowdown reduced land revenue. Reduced land revenue constrained fiscal spending. Constrained spending limited growth stimulus. Lower stimulus reduced short-term economic momentum. Layered onto this was demographic reality. China's working-age population peaked years ago. Birth rates have declined meaningfully. The labor force is gradually contracting. Demographic transitions do not cause immediate crisis, but they alter long-term demand assumptions. A shrinking workforce changes housing demand. An aging population alters consumption patterns. Lower birth rates reduce future household formation. These shifts happen quietly, but they influence investment calculations deeply. Meanwhile, consumer confidence has not fully recovered to pre-slowdown levels. Households observing volatility in property values tend to increase precautionary savings. When wealth perception softens, discretionary spending weakens. Retail sales growth moderates. And here lies the key structural tension. China's leadership has long signaled a desire to shift from investment-led growth to consumption-led growth. But consumption depends on confidence. And confidence depends on asset stability. When property weakens, the consumption transition becomes more difficult. Externally, the environment has also evolved. Global supply chains are diversifying in response to geopolitical tension and pandemic disruptions. While China remains central to global manufacturing, the automatic assumption of expanding export dominance has moderated. Some production capacity is relocating regionally. Trade friction adds complexity. Advanced technology export controls influence investment flows. Again, none of these changes imply collapse. They imply friction. Friction across multiple layers of the system simultaneously. The world often looks at China's official growth rate and sees stability, but growth rates do not capture structural quality. When credit expansion generates diminishing returns, meaning more debt produces less incremental output, the model begins to mature. Japan experienced something similar in the late 1980s and early 1990s. High asset prices, heavy credit expansion, strong export dominance. When the asset bubble corrected, Japan did not collapse overnight. It entered a prolonged adjustment period. Growth persisted, but at lower levels. Debt burdens became more visible. Policy intervention became more frequent. China is not Japan, but structural parallels deserve attention. The slowdown is bigger than it looks because it reflects the maturing of a credit-intensive, property-heavy growth model under demographic constraint. That transition is inherently slower and more complex than cyclical downturns, and the global system has not fully recalibrated to that reality yet. If China's slowdown were contained within its borders, it would be significant but manageable. The reason it matters globally is because China is not simply another large economy. It is deeply embedded in global demand, commodity pricing, supply chains, capital flows, and corporate revenue structures. When China accelerates, global growth forecasts rise. When China decelerates structurally, the impact spreads outward in waves. The first wave appears in commodity markets. China accounts for a substantial share of global consumption of industrial metals, such as iron ore, copper, and aluminum. These materials are tightly linked to construction, infrastructure, and property development. When property investment slows, commodity demand softens. That softness does not immediately cause collapse, but it alters price ceilings. Countries heavily exposed to commodity exports, Australia, Brazil, Chile, parts of Africa, begin to feel the pressure through trade balances and currency movements. Lower demand expectations reduce long-term pricing assumptions. Capital investment in mining becomes more cautious. Government budget forecasts become more conservative. The second wave touches multinational corporations. Over the last 2 decades, global firms integrated China into both production and demand models. Luxury brands relied on rising Chinese middle-class consumption. Automakers depended on expanding domestic vehicle demand. Technology firms leveraged both manufacturing efficiency and consumer scale. A structurally slower China changes revenue projections, not dramatically in one quarter, but gradually through lower growth assumptions. Earnings expectations adjust, valuation multiples compress, investment allocation becomes selective. The third wave is financial. Global investors monitor China not only for growth, but for stability. Foreign capital flows into Chinese equity and bond markets reflect confidence in long-term trajectory. When growth shifts from acceleration to stabilization, or even stagnation, portfolio allocation logic changes. Investors begin to demand higher risk premiums. Currency volatility increases. Capital outflow pressure can emerge. This is where policymakers face delicate trade-offs. China has substantial state capacity. It controls major banks. It influences credit conditions. It can direct fiscal support toward targeted sectors. These tools are powerful, but they are not infinite. Stimulus applied to a mature, debt-heavy system produces diminishing marginal returns. When each additional unit of credit generates less economic output than before, efficiency declines. This does not create immediate crisis. It creates long-term drag. At the same time, deflationary pressure has entered parts of the Chinese economy. Producer prices have shown weakness in certain periods. Excess capacity in some industrial sectors weighs on margins. If expectations shift toward lower future pricing power, investment appetite weakens further. Deflation is not dramatic. It is persistent. It lowers nominal growth. And lower nominal growth makes debt burdens feel heavier in real terms. The demographic factor amplifies this dynamic. An aging population alters consumption patterns toward healthcare and savings rather than housing and durable goods. A shrinking workforce reduces potential output growth. Urbanization momentum slows. These are slow-moving variables, but they are powerful. Comparisons to Japan's experience after its asset bubble are often raised. Japan did not collapse. It experienced prolonged stagnation, low growth, low inflation, repeated policy intervention. China's situation differs in important ways: income levels, political structure, capital controls. But structural parallels exist in credit saturation and demographic shift. The risk is not sudden implosion. The risk is extended underperformance relative to historical expectations. Why does this matter for the broader system? Because global growth models over the past 20 years implicitly assumed continued Chinese expansion. Infrastructure demand was projected with China as anchor. Emerging market supply chains were structured around Chinese manufacturing integration. Commodity supercycle narratives depended heavily on Chinese appetite. If China transitions from expansion engine to stabilizing force, the baseline for global demand adjusts downward. That adjustment is subtle but significant. Geopolitically, slower growth also influences policy. Economic strength supports diplomatic leverage. Moderation in growth constrains strategic flexibility. It may encourage internal stabilization efforts over external expansion. It may shift trade negotiation dynamics. None of this implies confrontation. It implies recalibration. Financial markets struggle with recalibration because it is not binary. It is easier to price collapse or boom. It is harder to price slow structural drift. Slow drift affects long-term earnings forecasts, not immediate headlines. It shapes capital allocation over years, not weeks. The deeper misunderstanding outside China is the assumption that government control eliminates structural limits. State-directed systems can manage volatility, they can prevent cascading panic, but they cannot fully override demographic arithmetic or diminishing investment returns. At scale, structural constraints eventually surface. The most important point is this: China's economy is not imploding. It is decelerating structurally under multiple overlapping pressures. And structural deceleration at this scale reshapes global expectations. Commodity exporters adjust, multinationals revise projections. Investors demand new risk premiums, policymakers respond more cautiously. Global growth forecasts shift incrementally. The slowdown is bigger than it looks because it is not cyclical, it is systemic, not a quarterly dip, but a transition from one model to another. Transitions are rarely dramatic, they are complex. They involve policy experimentation, selective stimulus, sector rotation, and long-term recalibration. They test resilience, they reveal constraints, and they force the global system to adapt. For decades, China was viewed as the marginal buyer, the incremental driver, the automatic accelerator. Now it may become a stabilizer rather than an engine. That shift is not loud, but it is consequential. Markets are beginning to recognize that the era of effortless Chinese expansion has ended. What replaces it remains uncertain. Higher quality growth, slower but more balanced development, prolonged stagnation. Those scenarios differ in detail, but they share one feature. The world must adjust its expectations. China's slowdown is bigger than it looks because expectations were built on momentum. And when momentum changes, so does the entire trajectory. Not overnight, but over time. That is what markets are slowly pricing. Not collapse, not crisis, but structural recalibration. And structural recalibration is far more difficult to model than panic.